Hello everyone, today with MarketXLS we're going to talk about a popular options trading strategy known as the long put option strategy. MarketXLS is one of the top Excel-based investment research solutions for investors. It makes it easier for you to turn your Excel skills and market knowledge into profit. In this video we'll be learning what a long put option strategy is, how it works, when to use this strategy, what is the possible range of return, and finally, we'll understand how MarketXLS can help investors to implement this strategy. So without wasting further time, let's start with the topic. This strategy is implemented when the trader has a negative outlook of the market or the stock. Long put is used when the trader has a bearish view of the stock or market. The closer the strike price will be to the current price, the better the gain the trader will get if the view proves out to be true. A long put is an option strategy comprised of being long on the put option. The maximum loss that can be expected is the net debit of the strategy. The net debit means the net cash outflow, which is equal to the premium of the call option the trader paid. So in short, the maximum loss would be limited to the premium paid. The maximum profit can be unlimited if the stock price continues to fall. MarketXLS offers a template for this strategy, and here's an introduction page. Here is the active template. The cells in yellow have to be inputted by the user, so the stock ticker, expiry date, strike price, and the plot gap. Some upcoming expiry dates, the current share price, and lot size are available for the investor's reference on the right. For the purpose of this video, we'll be using Apple as the stock ticker, expiry date as 25th June, and we'll be buying one lot of put option at 135 strike price. The net cash flow would always come out as negative since the investor is buying the call option, and hence there will be an outflow in the form of premium. In this case, the net cash flow is negative $174, which is the result obtained when we multiply the number of units with the premium paid and the lot size. MarketXLS has many templates just like the long put one you see here, and it refreshes all the data when you click on Refresh All. MarketXLS offers a net payoff table and a net payoff diagram to help the user observe the potential profit or loss at different expiry levels. The table contains the net payoff of the strategy at different expiry prices. In the chart, the y-axis is the net payoff of strategy and the x-axis is the range of expiry prices. Maximum profits are unlimited and maximum loss is limited. Maximum loss occurs only when the price of the stock increases. For example, in this case, the maximum loss will occur after the increase in expire price above $135, which is the expiry price, and as a result, the maximum loss is limited to the amount of net premium paid or the net cash flow. Maximum profits are unlimited if the stock price decreases. That is all for today. We hope we were able to help you understand how to use MarketXLS for the long put option strategy. If you want to read more about this topic, please visit the MarketXLS website, which has hundreds of blogs and templates. If you want to get in contact with us, please book a demo and we'll be happy to help.